As Mary said, I'm corporate counsel here at Alerus. I head up the legal team that deals with retirement plans. And what we're going to try to cover this afternoon is really a couple of things. At a high level, we're going to try to address certain plan administration and design issues that were always there, regardless of the fact that, we had this crisis. The COVID issue is just heightening considerations. So we're going to try to point out some top-of-mind things that you should keep in mind with regards to your own plan. And then we're going to move on and talk about the new legislation that passed, the CARES Act, and specifically we're going to look at distributions, the change in loan limits, some repayment relief, and RMDs and how they're going to impact both participants and plans. And as Mary said, best if you have questions as the presentation is going on, post those on the fly. That'll make it easier for Mary to sort through those questions and give them to me at the end of the presentation. So with that, we're going to get started. Plan administration issues. First question that we've been getting from some employers is with regards to these two new government programs. One is the Families First Coronavirus Response Act, and the other is the Paycheck Protection Program. Both of these are, if you are participating in these and you have employees that are benefiting because they remain on your payroll, then treat that as if they were still under your roof and working for you. Even if they're at home and you're sending them paychecks and they're furloughed and you're doing it because of the Paycheck Protection Program, or you're doing it because of the FFCRA and they have a COVID-related event and you're giving them the 2 weeks paid leave. It's just like any other paid leave or FTO. You're going to count that for deferral purposes, and then you're also going to count it for any type of company contribution. So if you have a match or you are utilizing a profit-sharing allocation, those hours and that compensation still counts for plan purposes. And the top bullet point here, this is why. These are the definitions of compensation, and every plan has to select one of those three, and under every one of those definitions, when you pay folks as part of these programs, the fact that you pay them makes it compensation for plan purposes. Okay, moving on. Timing of plan contributions. This is not something new either. I think most folks on this call know that if you take money out of people's pay, that is a plan asset. It belongs to the participant, not to the employer. And we then have an obligation to segregate that and get that to the plan. If you are a large plan, more than 100 participants, you have to do that as soon as administratively feasible. If you have less than 100 participants, you have a safe harbor where the DOL says you have 7 days to do that. Now, under these strenuous circumstances, if there was some reason that you just couldn't do the payroll run, or you did the payroll run and you couldn't segregate the funds, based upon facts and circumstances, I'm sure that the Department of Labor would, give you some leeway, but don't count on that. If you have the ability to run the payroll electronically and you can send off the paychecks, the assumption is going to be that you can also send off the corresponding contributions to the plan. When you get to the employer contributions, you have a little more leeway there. Even if you have been sending in the contribution on a payroll basis, the employer's portion of the contribution, you do have the ability to hold that and submit it at a later date. So you have up until the due date of your return to contribute employer contributions for the previous plan year. There's an exception. If you are a smaller employer, many smaller employers have adopted safe harbor plans, and if you're providing a safe harbor match and you are calculating that on a payroll basis, then rather than at the end of the year, you have to have that in by the quarter following the quarter that you do the payroll. So, for example, if I run the payroll in March of 20, I have until June 30 of 20 to make the employer contribution if it's a safe harbor match. But otherwise, a lot more flexibility as far as the employer contribution is concerned. Okay, the next slide you're looking at here is dealing with plan terminations. And the reason that I bring this up is that some employers, as a result of concerns about everything that's happening now, may be inclined to think about, I'm going to get rid of my plan because it's just one less problem I need to address. The reason I point this slide out is because although you may think you are getting rid of a problem, really plan termination is not going to make life that much easier, and in some cases may complicate it. So first of all, in order to terminate a plan, like all plan actions, requires documentation. So first bullet point you're seeing here, the board has to take some action. There has to be a plan amendment. In some cases, a money purchase pension plan, that's what MPP, or a defined benefit plan, so a traditional pension plan, they do have a notice requirement. K plans, 403B plans, profit sharing plans, you can terminate that plan, stop that plan, just by passing a board resolution and having one of your officers sign a plan amendment. Keep in mind, though, that that only has prospective impact. It does not take care of any type of accrued obligation that already exists. So if you are terminating the plan and you have obligations that are already locked in for 2019, or let's say that you have a fixed contribution that you promised your employees through the date that you terminate the plan in 2020, not only do you have the obligation for 19, but you have the obligation to make that employer contribution through the period in 20 when you actually terminate the plan. Of course, all employees become 100% vested, so if you have those forfeiture accounts that you were able to previously use, those participants who would otherwise be forfeited, they're not going to be forfeited, they're going to become 100% vested. And then here's the issue with regards to the plan itself. Even though you pass the board resolution and you terminate the plan, so let's say that we decided that the plan was terminated as of today, you still are going to have a lot of winding up effort, probably more than you would have just in normal everyday administration of the plan, because now you're going to have a final census that's going to be due. You're going to have plan administration issues, because keep in mind, when you terminate the plan, all of your participants then are going to have a distributable event. So you're going to have to be dealing with all those distributions. You're also going to have a 5,500 obligation that's going to continue, and that goes so long as you have assets within the plan. So you may terminate the plan today, but all these winding up things continue on. And then finally, if you wanted to start another K plan or another 403B plan, you can't do that until 1 year after all of the assets are distributed from the terminating plan. So if you terminated the plan today, and then let's say the last dollar leaves the plan 6 months from now, that 1 year period is going to start 6 months from now before you could have another 401K retirement plan. Related to the issue of plan terminations is this concept of a partial plan termination. And this is something that you don't do affirmatively. It's actually something that occurs and oftentimes unknowing to the employer. And here's the general concept. The tax code has a provision here under 411 that deals with vesting. And what it's designed to do is to prevent a situation where the employer is just going to lay people off and prevent them from vesting, collect their forfeitures, and kind of rig the system. And so there's a rule that says if there's a partial plan termination, all those folks that are affected and can't vest any longer, those people then become 100% vested. Unfortunately, the statute only talks about facts and circumstances, which is not a good way to try to describe something because you don't know if you're in or out. And so way back in 2007, Uncle Sam issued this revenue ruling, and that's what you're looking at here on this screen, is describing what exactly a partial plan termination is. And so I'm going to save you a lot of the details because that's what you have, you know, your admins here at Alerus to help you through and the business advisors. But this is the general concept. If you have an event, employer initiated, where you lay off 20% or more of your active employees, at that point you have a partial plan termination, and all those people that you laid off become 100% vested. So if your plan doesn't have a vesting schedule, don't have to worry about this slide. Also, if you are the employer who, let's say because of, you know, the COVID situation, you had to lay off 90% of your workforce. The beauty of this revenue ruling is it still has some flexibility. So the 20% is the benchmark, but it's 20% over what is called the applicable period. And that is where you have the flexibility because there's no hard and fast rule on what exactly that period is. So we get into this, and as of today, you have 90% of your workforce is collecting unemployment, and so potentially, you know, you have a partial plan termination. But if you bring those folks back, you know, in the next couple of months, you know, the revenue ruling is designed to look at that, and it references situations where layoffs are then rehired. And it makes sense because the statute's designed to protect those people that couldn't otherwise vest. When you bring your employees back, you know, you're giving them the opportunity to continue to work for you and to acquire hours for vesting purposes and to move on. And so merely because 90% of your workforce is gone today, don't assume you have a partial plan termination. But if that continues, and it continues for, you know, for sure you get past a year, at that point you probably have a partial plan termination. But visit with your Alerus representative if you have those types of concerns. Also, if you aren't quite sure if you have a partial plan termination or not, the final bullet point here is just a suggestion. You know, as an employer, you can always try to document the status and then determine which employees count, you know, so you have a board resolution that clarifies the period of time and that, for example, you know, everybody laid off between April 8th and December 31st are part of this group of affected employees. That would be another way to deal with it if indeed you are at that 20% or more. Okay, moving on. This, I think, might be obvious to a lot of folks, especially if you're involved in HR. When you have a plan document, whether it's for a retirement plan or health and welfare benefits, you know, in order to change that document, it's not just based upon intention, or even if you have email trails going back and forth, the IRS requires documentation. And in the retirement world, documentation means that your board or governing entity has taken action and that an amendment has been signed by an officer of your company. And at that point, that's when the plan amendment becomes effective. And the general rule is that those amendments are only effective prospectively. You can't back up and take away an accrued benefit from an employee that has already been locked in. And by locked in, I mean that this is not a discretionary formula, or it's not one of these situations. For example, here at Alerus, we have an ESOP. Every year, you know, we tell folks about the fact that, historically we've given a 3% contribution to the ESOP, but always couched in there is, the reminder that, this is a discretionary contribution and that it's, on a historical basis, always been 3% of comp. That's not locked in. That's not an accrued benefit, and that would be an example of, in 2020, if Alerus, for our own employees, decided they wanted to change that structure, they could do that even though, we have told them that we provide that. But we always couch it in terms that it is always discretionary. So anyway, keep in mind, got to take action if you're going to change the plan. Also have to notify participants. That's what the summary of material modifications is about. And here's where you may need to do a plan amendment. I think for plans that have some type of hard-coded contributions, so your match formula is actually baked into your plan document. It says that you are going to contribute 50% of the first 6% of deferrals as a match. That is a accrued benefit potentially, unless your plan had what's called an accrual requirement. That is where you would be requiring people to work for you on the last day of the plan year, or to have at least 1,000 hours of service in order to get that match. And you make the match at the end of the plan year. Then even though it's hard-coded in the plan, that's an example of a benefit that's not yet accrued, because at any point between now and the end of the year, there's the potential that that individual would not get the match, and so the employer can change the rules mid-year. Also, for those employers, and usually this is smaller employers, special considerations anytime you're changing a safe harbor plan, and that's what the next group of slides is about. This is specifically concentrating on plans that have made this election, and the election basically is one of two choices. You either promise all your employees that they're going to get a 3% contribution based upon their compensation for the year, or you promise all your eligible employees that they're going to get a match, and the match has to be at least a minimum of 100% on the first 3, 50% on the next 2% of deferrals. Those are the two basic options in order to create a safe harbor. So those employers that do that normally are doing that because the benefit is that the highly compensated employees then can defer, and you don't have to be concerned about what the rank and file are doing in the way of deferrals. You avoid the ADP test, and that works oftentimes for a lot of smaller employers. So, law offices, dentists, small doctor clinic firms, but even some larger employers do that. For example, here at Alerus, we have a safe harbor plan even though we have 900 employees. But if you have a safe harbor plan and you're thinking about making a change, here's the first point of inquiry. You have to ask if that plan is top-heavy. And the reason that you ask for that is because if you decide to leave the safe harbor, which you can do, and I'm going to show you in a minute how to get out of it, but the downside then is if your plan is top-heavy, you still have the top-heavy minimum contribution that's due. So in some settings, especially for smaller employers, you may not have accomplished much by leaving the safe harbor, and that's because if you look here at the bottom bullet point, the top-heavy minimum contribution is 3% to all of your employees. And so that's taken care of if you have made a safe harbor election. If you exit the safe harbor, you're still going to have that obligation, so you haven't really accomplished anything. So what I want to leave you with here is if you do have a safe harbor plan and you're thinking of making changes to it, first inquiry is get a hold of your admin who is handling your plan. They will look at the last year's testing because that's when this determination is made. It's the last day of the previous plan year. So we're in 2020. If you have a calendar year plan, that calculation was done as of 12/31/2019, but it affects the 2020 year. They will be able to tell you within minutes whether or not your plan is top-heavy. If it is top-heavy, then you're going to have to keep that in mind when you make some of these decisions. And here are the decisions that a smaller employer who's made this election, they have basically two choices. One is they can try to terminate the plan. I shouldn't say try, they will terminate the plan. Or in the alternative, you keep the plan going, but you just back off and stop the safe harbor contribution. So this slide that we're looking at here is talking about the plan termination. That's your first option. In many cases, not a great option because remember, you stop the K plan, you can't have one for a year. All those things we talked about in the previous slide apply in the safe harbor setting as well. Plus, you have these considerations. So first of all, can you terminate? And the answer is yes. You don't need any special reason. But if you have a business hardship reason, which I would think many employers are already facing either economic loss or substantial unemployment, sales or profits depressed, all of those things would be part of the factors that you'd look at to say that you have a business hardship. And if you have that and you decide to terminate your plan, then you keep the safe harbor protection, including, the Highleys being able to defer and the fact that you don't have to make the top-heavy exemption. All of that continues if you are terminating the plan because of business hardship. If you don't have a business hardship, then basically all of the tests apply and you have to make the top-heavy contribution. In both cases, when you terminate the plan, whatever your promise was up until that point, so for example, if I had promised a 3% contribution to all my employees and I terminate the plan as of today, then up through today, based upon compensation, I still have the obligation to fund the plan on compensation through the date that I terminate the plan. No advance notice here. It just immediately stops when you pass the board resolution and sign the amendment. So moving on, here's your other option. You have a safe harbor plan. You want to continue the plan, but you just don't want to have the expense associated, with the company contribution. You're going to exit the plan for this year. You can do that, and in the Alerus environment, all of our safe harbor notices have this magic language that you see at the top here. That's what gets you home or allows you to stop that safe harbor contribution at any point. The bottom bullet point here is how you stop it. You have to do two things. You got to notify all your participants that you are stopping it, and we have the notice that you would give to your participants, letting them know. They have to have that for at least 30 days, and you have to sign an amendment. So if you were really in a rush to get out of this, you could get a hold of your administrator today. Probably in the next day or so, they could give you the notification for participants, and you would get that out right away. And then between now and the end of the 30-day period, that's where your company would sign the amendment. And the amendment would be effective on day number 30, and that would be when your safe harbor would exit. So in the meantime, you would still have the safe harbor obligation. So if I gave my employees the notice today, 30 days down the road is when my safe harbor contribution obligation ends as an employer. So if I had a 3%, I would have to continue to pay 3% of compensation between now and day 30. And then on day 30, I no longer have that obligation. But keep in mind that you will have the obligation up through day 30. And also, you are going to have the ADP ACP test. So if I'm the highly compensated, I'm one of the owners, you're going to look at my rate of deferral versus what the rank and file did for this year. And remember, the general rule is I can do 2% more than my rank and file. Anything above that, on an average, anything above that, then I'm going to get a refund for contributions that I made in 2020. But here's the biggest concern. Remember I said, top-heavy contributions are problematic for a small plan. That top-heavy contribution exists. So unlike in the situation where you terminate the plan, and if you do it for a business hardship reason, you still have the protection of the safe harbor, and you don't have to make the top-heavy contribution. In this scenario, regardless of why you are exiting the safe harbor contribution, you still have the top-heavy obligation. So what does that mean? If my plan is top-heavy and I get out of the safe harbor today, although I only have to make the safe harbor contribution up to the day of day 30 of the notice, so I make that contribution. But then when we are doing the testing for you and we see that the plan is top-heavy, at that point for the balance of the year, you still owe 3% to all your participants based upon the fact that the plan is top-heavy. So you wouldn't accomplish anything. So that's why the bottom line here, if you have a safe harbor and you're thinking of making a change, what's the first thing you do? Contact your admin, find out if this plan is top-heavy. If it is, that's going to flavor which choice you take. Okay, so that is kind of the high-level considerations, or at least top-of-mind considerations that we're seeing currently with regards to plan changes. Now I want to move on to talking about the changes that have come about because of the CARES Act. Now keep in mind, the CARES Act was only passed on March 27th. Normally when Congress passes a bill, the industry has, a year to have some thought about how it's all going to work, and then Congress passes the bill, and oftentimes the implementation schedule is another year or so down the road. In this situation, on Friday the 27th, Congress passes the bill, and guess what? Immediately effective. So, the entire industry is scrambling. If you hear different messages, or, if the message changes over time, just kind of take it with a grain of salt, because I heard it best described. Some folks say, we're building the airplane while we're flying it. That's the challenge that we're faced with here. So, starting out, I've noticed that there's a lot of confusion about a CARES Act distribution and how it affects a participant and how it affects a plan. So think of it as two separate problems, okay? So first of all, what the federal law did was it creates an opportunity, a tax filing opportunity for the participant. It has nothing to do with the IRA or the plan. This is just the participant. And if the participant is qualified, and we're going to talk about that in a second, what you need to be a qualified participant. But if you make it in the door and you're a qualified participant, what does that mean? Well, I have the opportunity to take money out of a plan or out of an IRA, and I have special tax reporting rules. And we'll talk about that too, but in a nutshell, I can average that over 3 years. I don't have to pay the 10% penalty for early withdrawals. There's a number of benefits that the individual receives. But here's where I see some confusion. The law says that the individual can self-certify. That is just for the plan. From the plan standpoint, you don't have to adopt a CARES Act distribution provision. You could leave the plan just as is. What the CARES Act permits on the plan side is for you to temporarily loosen the distribution restrictions that would otherwise be in place. So as an example, in a 401k plan, normally while the individual is employed by you, that individual cannot access any of their deferrals. The 401k deferrals, can't touch it. If it's a safe harbor plan, they can't touch any of the company money that went into the plan. There's a number of rules that lock down, how people can access money. If your plan adopts the CARES Act provisions, then temporarily, just for 2020, you are removing those restrictions and allowing folks to get at the money more easily. But even if the individual can't get at the money more easily, let's say that the employer says, no, I'm not monkeying around with any of this CARES Act stuff. It's just business as normal. But then I, as a participant, let's say that I have a bunch of medical bills that I don't have insurance coverage for, and I apply for a distribution, and my son or daughter, has been diagnosed with COVID-19. I then, by definition, am a qualified individual. And when I pull that $10,000 out of the plan for my hardship, even though the plan has changed nothing, when I get that $10,000, I can treat it on my 1040, and I can report it 1/3 in 2020, 1/3 in 21, 1/3 in 22. I don't have to pay the 10% excise tax. So this is all on the participant. Likewise, when it comes to the certification is to benefit the plan. So when the participant signs the certification, that's the end of the plan's inquiry. You don't have to get into the weeds and find out whether this individual actually got tested or the test came back positive or that they're having financial problems related to COVID-19 or any of the qualifications we're going to talk about. In fact, in my opinion, stay out of that. The change in the law gave employers a pass, so use it. This is a freebie. You got enough headaches? Don't make life worse. If the individual gives you a certification, end of story. You don't have to be figuring out whether or not that certification is valid. But on the participant side, if the participant signs a certification, they're not home free, right? Because let's say that my spouse lost her job, and so I decide I'm going to pull money out of the plan. I sign the certification, and the plan gives me $30,000. And then at some future date, the IRS audits me and says, John, we see that you had this special reporting in 2020. Show us why you were qualified. And so what I provide the auditor is the certification. I say, see, I signed this. And the auditor is going to go, no. I want the underlying documentation that you were qualified. That certification, when you sign that, that's just for the benefit of the employer. And so I tell the IRS agent at that point, I say, well, Jackie got laid off. And the IRS agent looks at the qualification issues and says, well, that's not a qualification. You lied when you signed that certification. The plan's okay. They didn't do anything wrong. They gave you the $30,000 because you gave the certification. But you, Mr. Taxpayer, John, you're going to now have to pay income tax on that 30. And that's where I think we get confused about this as far as whose obligation it is. The employer, to a large extent, is kind of given a pass here. If they want to implement this, they can. So let's look at what a qualified individual is. There's two categories. There's the account holder and their spouse or dependent, and this is where they're actually diagnosed with COVID-19 by a CDC-approved test. Or the other alternative is the account holder, so not their spouse, not their child, but the account holder experiences these adverse financial consequences that are tied to one of these things: quarantine, furlough, reduced hours, problems with child care because of COVID-19. There's even a category here for business owners. But once again, this is on the individual. You, as the employer, you don't have to figure any of this out. Individual gives you certification, and we've already prepared that form. We're updating it, but if you looked online today, you should all have that form in Plan Gateway under Plan Resources. It's available to you to use today. That's your pass if someone is asking for one of these special treatments, whether it's a distribution or if you provide loans, you want to use the loan provision, or they're asking to not pay payments through 2020 on a planned loan. That's the ticket for the employer. You get that. Here's what the participant can do. From the participant's perspective, they can pull up to $100,000 from all plans. Keeping in mind, this is not a limit by plan or by IRA. This is an aggregate limit. So if I pull, for example, $50,000 from an IRA, and then I pull $50,000 from my retirement plan, I hit the limit. I'm done. And once again, the plan or the IRA doesn't need to adopt these provisions. This is looking at it from the individual taxpayer standpoint. They can do it at any point, beginning with the first of the year all the way to actually December 30. This is a glitch in the law because the language says before December 31st, not as of. But in any event, so if I had a hardship distribution and I was otherwise a qualified individual and I had that hardship distribution that occurred even before the law was passed, I as an individual could report that on my 2020 income tax return as a special CARES Act distribution. Plan doesn't need to do anything to go back and change that or change the reporting. You know, that remains in place if something happened before March 27th. But the taxpayer does have the ability to go all the way back to January 1st and treat a distribution, you know, as a special CARES Act distribution if they are qualified. These are the plans you can get it from, and you'll see there's a long laundry list here. What is not included is non-governmental 457Bs, so those nonprofits like many hospitals have these that are used by doctors. Those non-governmental 457Bs are not eligible to receive this special treatment. Otherwise, all plans are eligible, all defined contribution plans are eligible, so and also defined benefit plans. What has posed some confusion is which plans can be changed to loosen up their distribution restrictions. And you'll see here in the second big bullet point, it's only K plans, 403B plans, governmental 457Bs, and federal thrift savings plans. Those are the only ones that can open up the distribution restrictions. If you have a defined benefit plan or a money purchase plan, you know, for example, one rule is that there's no in-service distributions before normal retirement age in those plans. So if folks are still working for you, they can't access this money. That rule stays in place. And so even though as a taxpayer, you know, I can take advantage of the CARES Act, if you are one of these folks that have a money purchase pension plan, or by the way, if you have a legacy issue where the money purchase plan is part of your main plan, you know, you merged it at some point, that portion of the plan is not open. You know, it's not open season on that. You have to still follow your regular distribution rules with regards to a money purchase plan. Okay, here's the tax consequences to the individual. No 10% excise tax, even if they're not 59.5. Mandatory withholding is waived. So what will happen is the default withholding is 10%, but if the participant wants, they can waive withholding altogether. And that, I think, is going to pose some danger here because, you know, some folks are going to be seeing on the internet that there's this opportunity to access their account. And because there's no mandatory withholding and because there's no 10% excise tax, they may think of this as free money. But here's the important thing to convey to your participants. Even though they can get at this money, and let's say your plan has opened up the ability to get at it more easily, it is still a taxable event. And there are only two choices when they get that money, is either to prorate it over 20, 21, and 22, so 1/3, 1/3, 1/3, or to recognize it all in 20. There's no other option with regards to income recognition. So what does that mean? They're going to have tax consequences immediately in 2020 when they take that distribution, unless they roll it over. But the problem here is when you roll over, you have 3 years from the date that you took the distribution. So not 3 calendar years, but 3 years from the date that you took the distribution to roll it into either an IRA or to an employer plan. And by the way, your plan does not have to remember who took a CARES Act distribution and then track that when it comes back. What the participant will do at some point is just like any other rollover to the plan. You know, they're going to complete a rollover contribution form, and at that point, the employer can rely on that form, and if the participant says this $30,000, you know, was a result of a CARES Act distribution, that's the end of the inquiry. They give that to the plan with a rollover contribution form. 3 years down the road, you put it into the rollover source, and that's the extent of the plan's involvement. So it's pretty clean from the plan standpoint. You're not going to have to babysit who got the distribution and whether or not it came back. Most of these burdens are going to be on the individual taxpayer. But anyway, back to the implications of this. When this rollover occurs, that's when they can start adjusting their taxes. So if I take a distribution, say, of $9,000 in 2020, and I elect when I'm doing my 2020 return to recognize $3,020 and, you know, $3,021 and 22, each year I have to add $3,000 to my reportable income, and then I have to pay the tax on it. And it's not until I do the rollover at some point do I get to go back and tell Uncle Sam, okay, remember I paid tax on that $3 grand? Give it back to me. That's when they get it back. So it's another important thing to remind folks they're going to have to pay the tax now, and then at some future date they'll be able to potentially get the refund. And although this is a new law, it's not totally new as far as how Congress has dealt with disasters before. And so in the final bullet point here, if you wanted to get into the weeds and see how reporting works, if you go to IRS Form 8915B, that form is for reporting of disaster relief for hurricanes. And if you remember, you know, Congress passed a law for various hurricanes and wildfires where people could take the same approach if they were qualified. We're just doing this now on a grander scale. Okay, some things that folks should keep in mind, and we're going to be putting together a participant piece that has these issues addressed. But in dealing with your participants, and our frontline people, you know, are communicating this to participants as well. First of all the things we talked about with regards to taxation, they have to keep that in mind. Also, state tax law is oftentimes or could be different than federal tax reporting. So even though federal tax reporting may allow you to report this in 3 chunks over 3 years, if the state tax law doesn't dovetail with federal tax law, then the individual is going to have to recognize all the income in 2020 on their state tax returns. So they need to be aware of that. Really, they probably will or should talk to their accountant before they decide to pull the trigger on some type of big distribution. Also, if it's a Roth distribution, this law does not magically make non-qualified Roth distribution qualified. So by a qualified Roth distribution, that means that the recipient does not have to recognize any part of that on income tax. But in order to be qualified, you've got to have 2 things. You've got to be at least age 59 and a half, and that money has to be seasoned. It's got to be there at least 5 years before it counts for special distribution rules or tax recognition at distribution. And if you haven't made that, then the portion of the earnings on the Roth distribution are still taxable. And so folks need to understand that as well, that if they access the Roth money and it's not otherwise qualified, it's going to be taxable to the tune of the earnings. They won't pay the 10% excise tax, and they will be able to spread their earnings over 3 years, but nevertheless, that portion is going to be taxable. And then, as I mentioned, the amended return needed for rollover. A couple of other considerations, you know, market's very volatile. It may be, you know, if they're accessing the account, they're selling in a down market. And then, the constant beat of drums that we always give to participants, retirement assets hopefully are used for retirement. And we realize, these are dire straits, but once you spend retirement assets, it seems like it's very difficult to replace. So we want people to think twice before they pull the trigger on some type of CARES Act or other distribution. And in closing on this one then, participants can take multiple distributions. So we're in a crisis situation, and this is not a good time to be making huge decisions with regards to future income tax. So my suggestion, if folks were talking to me, would be take a breath, access the account as needed, but you can come back and ask for more later. And so don't, unnecessarily load up with regards to the distribution today. See what the future holds, and if you need more, as long as you come in before the end of the year, you can ask for more from the plan. Here's the plan considerations with regards to the distribution. It is an optional provision. Our assumption is that most plans will want to loosen the distribution requirements, and so the email that you received last week explaining this new law assumes that this is the role we're going to take. But if you don't want to do that, you can certainly tell us to stand down, and we won't change how we operate your plan. So you can, if you're any of these plans here in the second bullet point, you can change your normal distribution restrictions. If you're money purchase or a defined benefit plan, you can't. The mandatory withholding is waived for anybody who is a qualified individual. So it doesn't matter if you've adopted the changes here to override the distribution rules. If the individual tells you and certifies that they are a qualified individual, that would be the opportunity for them to not have any withholding on a distribution. So let's say that your plan did not adopt any of these changes to override the distribution restrictions. You could do that. Individual comes in, and let's say they ask for a hardship. You could have no withholding. Well, I guess there's no withholding on a hardship anyway. But let's say that they're terminated and they're going to take $10,000 out of the plan. Normally, there's mandatory 20% withholding. They could avoid that 20% withholding if they gave you a certificate saying that they're a qualified individual. You let our distribution team know at that point, and then there would be no withholding whatsoever if they didn't want that. And once again, from the plan's perspective, participant can self-certify. Remember that as a plan sponsor, that's your ticket home. That eliminates a lot of problems here. So that is the distributions ins and outs. Let's go on to loans and repayment. These are on the loan side. This is also an optional provision. It is only in play for 180 days following passage of the law. So the law passed March 27th. If you do the count by the calendar, that means that loans could be issued under this special provision up through September 23rd. And just like the distributions, in order to issue this special loan, the individual has to be qualified. And also the individual, when they're asking for this special loan provision, if they certify that they're qualified, that's the end of the employer's inquiry. Here's what changed, the loan limits. So you see in bold there it says limits increased. Previously, plans could only make loans up to $50,000 and 50% of the account balance. Now, that rule stays in place unless someone is qualified, and if the plan wants to adopt these new loan limits with regards to qualified individuals, you can do so. We've developed an addendum to your loan policy, so you don't have to rewrite the entire loan policy. This would just be an addendum that's adopted between now and the end of the year. Don't have that quite finalized, but that should be coming to the resource library for those folks that have loans. We'll put that out there shortly so that you have that as well. And basically, it's just going to open up the special loans between now and the end of the year to qualified individuals. So you as an employer then obtain the certification, that together with the normal paperwork or whatever process you use to issue a loan, that process continues, and it's certification plus standard paperwork, then that's the documentation that that person qualified for this special loan provision. The other important thing to keep in mind is all the other loan rules stayed in place. So this isn't like a special loan or a loan on top of what would otherwise be a loan. This is just changing the limits. And so one issue that comes up is folks that already had a loan in the last 12 months. And Uncle Sam says that if you had a loan in the last 12 months, the highest loan balance during that period, called the look-back period, the highest balance offsets your ability to get another loan. So in our situation, if I have a $100,000 limit available to me and I have enough in my account to cover it, but I had a loan that I paid off, let's say with the highest loan balance of $30,000 in the last 6 months. In that example, I can't get a $100,000 CARES Act loan. I can get a $70,000 CARES Act loan because the loan limit is moved to $100,000, but I still have to honor all the other loan rules. And so in that example, it's $100,000 minus my highest balance in the last 12 months, which was $30,000. That equals a $70,000 loan that can be issued to me. Also on new loans, you're going to be able to start up the amortization as of January 1st. If you gave the money to them today, they would pay interest between today and January 1st, but then January 1st you would amortize the loan over a 5-year period. You don't have to worry that the loan is being extended too long. But that part of it, we have you covered too. We will do the calculation as far as the amortization and the appropriate length of loan for new loans if that occurs. And then the reasonable rate of interest, that requirement remains as well. So a couple of considerations for people that are asking for a loan, and these are probably considerations at any point if someone's asking for a loan, but especially in these stressful times. So normally, I'm inclined to tell folks that they should be taking a loan rather than taking a distribution from a plan. But in this environment, there's a couple of added considerations. If that individual can't afford the loan payments and they get the loan in 2020, and then when the loan payments start up in 21 and they miss the loan payments, at that point what happens is you're going to have a default in 21, and if you compare that to just taking a distribution in 20, they're probably better off taking a CARES Act distribution in 20 than taking a loan and defaulting on it on a later date. And that's because if I default on that loan in 21 or some future date, I don't have all the benefits I have of a distribution. So I can't average over 3 years. I have to pay the 10% excise tax, et cetera. So they should look at whether or not they can actually make those payments on the higher balances. And then, of course, they're selling in a down market. One other aspect of the CARES loan is with regards to repayments, and here too have to be a qualified individual to avail yourself of this special treatment. And what the special treatment is, if you are a qualified individual, then between March 27th and the end of the year, if you miss a loan payment, that's not considered a default. The individual does have to start making their regular loan payments beginning in January of 21. But any of those missed payments, they have 1 year from the due date of each payment to make it up. And so what does that mean? They have 2 options when it comes to fixing those missed payments. One option is basically to double up on payments in 2021. So for example, if I missed my April 2020 loan payment, I would have until April 2021 to make that payment plus interest for the last 12 months. I make that in addition to my regular April 2021 payment. I have to pay twice, and now that one was taken care of. And likewise, if I missed May, then in May of 21, same thing. I have to make two payments, one regular payment, one missed payment, plus the interest over the last 12 months. That's one option, probably not a good one for most folks. A more realistic option is if they miss payments, they can come back and have the loan reamortized and do that, in 2020, and then string out those payments. And any of the missed time in 21, they can reamortize, and they make up for those missed payments in 2020. And any of the missed time in 2020 doesn't count towards the usual limitation that the loan can't extend for more than 5 years. So for most participants who miss payments, if they're qualified and they're going to reamortize, that's going to be their preferred option. And what we are envisioning with regards to the self-certification is putting the burden on the participant to pay attention and to get back in and request reamortization come 2021. They're going to know, that they didn't make their loan payments. We're going to remind them that they need to get that reamortization going, but that's the extent of the hand-holding, I think, both for the employer and for third-party administrators. We do have to put some responsibility on the individual, and then they take it from there, and then we'll help them through the reamortization process beginning in 21. Okay, finally, we're going to talk about RMDs. Here's the short answer on RMDs. We monitor all RMDs, and so you don't have to figure out whether someone is in or out, other than when you get the notification from us that we're going to issue certain RMDs. And if for some reason the system doesn't indicate that they're employed, but you know that they're still working for you and therefore wouldn't be subject to the RMD, you have to give us a heads up. But otherwise, we handle it. There's no RMDs for anybody in 2020. Anybody who got an RMD in 19, unfortunately, that's not covered. They still have to pay the income tax on it. If you were someone who was 70.5 in 19 and you held off on paying your or receiving your RMD until April 1st this year, that is no longer an RMD. And so what does that mean? Even if the plan paid it to you, you can turn around and roll it into an IRA or back to the plan and avoid paying income tax on it in 2020. So that's why I bolded that, because that's an opportunity for some limited number of folks. But otherwise, generally, no RMDs for 2020, and they're going to start up in 21 just like before. All right. A couple more slides here, and then we're going to take some questions, Mary. So here's our current status. You received the email from us. That email included a certification or example of a self-certification that employees could use. As I mentioned, we're going to be updating that to address some other issues with regards to distributions and loan repayments. So stay tuned. That should be out on the web shortly. Our communication basically took the approach that the assumption is that the plans, if they're capable, they're going to loosen up the distribution restrictions, and if they have loans, they're going to adopt the higher loan limits. That's not required, but that is our starting point for discussion. At any point, you can tell us that that doesn't work for you, but our assumption is that the vast majority of folks would want to have these more flexible provisions. If you do have the provisions, our game plan is use current process plus the participant certification. That's going to get you home. If you are a plan that's utilizing our online loans, under those circumstances, the online arrangement is not designed to address loans in excess of $50,000. And because this is a temporary situation between now and the end of the year, we're not going to, reprogram everything. It'd be done by the time that the act is done anyway. So the approach really is, for now, if you have an online loan and somebody wants to exceed that loan balance, they get the certification, they'll do a paper application, and that's how we'll process something that exceeds, you know, the 100% of the account or $100,000, assuming that the individual is qualified and sent in the certification. We do have, as I mentioned, we're going to update the certification. There's going to be an addendum that's going to be available for your loan policy if you want to go that route, and also a communication piece that you'll be able to share with your participants that's going to address these issues like distributions, loans, etc. So, your options. The top 4 bullet points here are the options we're hoping that the majority of folks use, and that would be accept the defaults, and so far we're seeing, you know, most folks taking that approach. We've had a few folks reject the defaults, but I think with further discussion they may change their mind, but that's an employer decision. If you don't want to have the distributions, you know, remove the distribution restrictions, you don't want to have the increased loan limits, that's legitimate. Or you could pick one and reject the other. So accept distributions, reject loans, or reject distributions and accept loan changes. Those are available as well. We're hoping that people fall into one of these categories. You can slice and dice this 1,000 ways, and you know, I can say this because I'm a lawyer, so you know, lawyers can say bad things about other lawyers and get away with it, but you know, we can really overthink things, and there's a lot of ways that you can design this, you know, a month of Sundays, but this is a relatively short period. People are already stressed, you know, so my suggestion is to try to think of a clean approach, and that you pick one of the above, and then, you know, that is the approach you take. Also keeping in mind that if you pick this first one here and accept the defaults, the CARES Act is really giving you as a plan sponsor cover with that certification process, and the key really is making participants aware, like all aspects of retirement plans, you know, that the participant is kind of controlling their own destiny, and it's our job to try to educate them about what the options are, and then they know their individual circumstances, and they decide if they need the distribution or they can afford payments on a larger loan. You know, our job really is to educate, then they pull the trigger and make the final decision. Okay, well, Mary, I went over again, 3:05.
Done. You did fantastic. Thank you so much. It's a wealth of information. We appreciate you taking the time to go through it. We do have some questions that came in from the Q&A, so thank you to those who submitted those questions. Let's start with the first, John. Dennis asked a question. Do we have to officially amend our plan for the changes that have been passed through the CARES Act?
And the answer is yes, but the good news is that Congress thought of this too and said that the amendment is not needed until the last day of the first plan year that starts in 2022. So for a calendar year plan, that means you have until December 31st, 2022 to actually adopt the amendment. This is one of those situations where you have the ability to retroactively adopt an amendment that reflects your operation in the interim. And keep in mind that there's other plan changes that are coming. So there is the Secure Act that's going to require changes to the plan. So at this juncture, you know, when it comes to the underlying plan documentation, way premature to try to figure out, you know, what exactly that's going to look like, how extensive it's going to be. The short answer is there's going to be changes to your plan, you know, even if you don't want to make more liberal distribution rules. Remember, all the RMD rules are changed. So your plan document references 70.5 in a number of places. So at a minimum, that plan for 2020 is going to have an addendum that says, hey, and in 2020, you know, none of these rules apply. So I know there's a lot of questions about the need to amend. Short answer, yes, it's needed. But, you know, keep in mind this is not an immediate problem. This is something that's going to happen well down the road. And if we're providing the plan document for you, you know, we will babysit what aspect of the CARES Act your plan utilized and, you know, get the appropriate amendment out to you in due time. Other questions?
Excellent. Yes, excellent, John. Thank you so much. Another question came in from Jenny. Jenny asked, if our plan does not allow for loans, does this apply even if a participant self-certifies?
So the self-certification doesn't change the plan. You know, if the plan doesn't permit loans yesterday, it still doesn't permit loans today. Now, and so our mailing to everybody, you know, the email basically was telling people that if you have a loan, loan provision, that in that plan we're going to increase the limits to the $100,000. But if your plan does not have a loan provision, it still doesn't have a loan provision today, you can certainly contact us and say that, you know what, I want to implement loans, and I'm going to amend the plan to allow loans going forward, including these enhanced loans. But otherwise, merely receiving the certification doesn't create the obligation to give that individual a loan.
Great, thank you, John. Question from Valerie. If someone is only out for the 80 hours of the FSCRA, does that qualify them to suspend loan repayments? And if so, for how long?
Okay. So once again, this is the beauty of self-certification. The individual, you know, doesn't matter if they're still working for you, right? If you look at what it means to be a qualified individual, it means that I or my spouse or my child's been diagnosed, you know, with COVID-19 and certified, or, you know, through a CDC test. That gets you home, or that I have, you know, any of these other financial issues. So, you know, when the participant comes to you and gives you a certification and says, Mary, you know what, I'm not paying any of my loan payments for 2020. It's kind of a holiday, you know, and they sign the certification. I, as the employer, I'm done. I don't have to collect a dime from them. You know, I got the certification that that individual is qualified. That's the end of my inquiry. I don't collect for the end, or to the end of 2020 unless that person, you know, if they want to make payments, they certainly can, but they have no obligation to make it if they're a qualified individual. And I, as the employer, don't have to figure out if they are or not. I get the certification. I'm good to go.
Thank you, John. And just to clarify, the second part of Lisa's question is there an amount of time they have to be a qualified individual to receive any of those temporary provisions?
No, they back to the self-certification. I know that I'm kind of kicking a dead horse here, but that's from the employer's perspective. You know, if I'm the employer, I don't want to get into an analysis of are they in, are they not, you know, how long. No, 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 no. I get the certification, end of story. That's my documentation, you know, and that's the beauty of that arrangement is the employer is off the hook.
Great. Thank you, John, for clarifying that. Another question from Roxanne. If the plan only allows one loan per person and the participant already has a loan, can they take out another loan for the CARES Act?
And the answer would be no unless the employer changes its loan policy. So, you know, keep in mind, remember, you know, I said that for the CARES Act, the impact, all they did was change two little parts of the code temporarily for 2020. They took the number 50,000, they made it 100. They took the line item that said 50% of the participant's account, and they made it 100%. And they said that that applies to qualified individuals between now and the end of the year. That's it. So all the other aspects of issuing loans and, you know, loan policy limits, all of those remain in place unless the employer decides that they want to change that. You know, if they want to permit a second CARES Act loan, they certainly could do that, but if they don't want to, they don't have to. And they would change their loan policy to reflect that, probably as part of the temporary addendum, you know, that for this small group of qualified individuals, they can have 2 loans, and this is not going to be opened up forever. You know, this is just a temporary solution to this problem.
Okay, great. Thank you, John. One more question from Michelle. What forms do we use for qualified individuals who want to take a distribution?
Okay. So it's standard operating procedure, so view it just like anybody trying to get a distribution from the plan. And the reason that I kind of stay away from the detail is because, you know, we have plans that use all types of arrangements. Some that, you know, we work with outside TPAs, some is through us, some is electronic. So whatever the standard procedure is, utilize that same procedure, plus get the certification. And those 2 pieces together then document that that individual was qualified, and that's why we could do some type of special treatment to them, whether it's giving them a distribution that they wouldn't otherwise receive or giving them a loan that they would otherwise exceed the loan limitations. So that's the short answer. Use the standard operating procedure, couple that with the certification, and from the employer's standpoint, you're good to go.
Perfect.
Anything else, Mary?
Thank you so much. We do have, let's see. I think we are end of time here, John. So I do want to thank everyone for joining today's session. Again, John, thank you so much for sharing the wealth of information. If anyone does have any additional questions due to the time, we will be able to follow up with you individually, or if you have additional questions, I encourage you to reach out to your Alerus representative. As I mentioned earlier at the beginning of the presentation, we will be sending a copy of the presentation materials and a copy of the recording of the session via email. Please look for that within a day or 2. And you can, John, any final comments or remarks before we close?
No, I think I just about ran out of steam, so we're
okay.
We're done.
Well,
we're done.
We appreciate that, John. And thank you, everyone, for joining. Have a wonderful afternoon. Bye-bye now.
Bye.